Less than 6 months ago, no one expected that by summer, the Fed wouldn't just raise the rates, but would start to shrink its balance sheet. If you remember, Jay Powell for almost 2 years kept saying that we're not seeing any signs of inflation getting out of hand, even though the rates were at their minimum. But in the last 6 months, the Fed raised the rates 3 times. First, back in February by 0.25%, which to be honest didn't really do much, but sent a clear message to the market that the age of cheap money is over. However, the market didn't really understand that. So in March, it raised the rates by a higher percent, 50 basis points. The market crashed, tech stocks plummeted, and crypto went to zero. Some crypto coins literally went bankrupt, such as Luna, which seemed like a promising project that is now worth nothing. Even stable coins that are connected to the US dollar lost over half of their value. How would a coin that is pegged to hard cash dollar plummet so much? The answer is simple. Investors are so doubtful of this technology that they are thinking of selling off and getting out before everything collapses. Little did everyone know that the worst was yet to come. In June, Jay Powell, the chairman of the Federal Reserve, announced that the Fed is raising the rates by another 75 points, which sent shockwaves across the market. Not only it destroyed the entire stock market, but it also put a huge question mark on the future of the housing market, since interest rates at 1.75% brought mortgage rates to the point where the vast majority wouldn't be able to afford. And those who will be able to afford a home will see a significant reduction in their budget, which will bring down the demand, which will eventually bring down prices. If you're wondering why I haven't mentioned crypto yet, that is because if a 0.5% increase caused such a crash, what do you think a 0.75% increase would do to crypto? Since the 6th of June, when the market expected the Fed to raise the rates, Bitcoin has already dropped by a third percentage. Coins such as Solana now cost a fraction of what they used to cost at their peak. I wouldn't be surprised if Ethereum will cost less than $1,000 by the time this video is out. The problem is that this is not the end. Because as I was writing the script for this video, Jay Powell said that next month, the Fed might be raising the rates by another 0.75%. That will raise interest rates to 2.5 to 2.75%. That would make them as high as they have been in March 2008, when the Fed tried to control the housing market by raising interest rates. But that raises a few questions. Will that cause another recession? How bad will the coming recession be? And how will that impact the stock market? We'll answer all of these questions and many more. But before we do that, give this video a thumbs up and let's get started. Janet Yellen, the former chairman of the Federal Reserve and the current Secretary of the Treasury, said that in front of the Congress that bringing inflation down should be a top priority. Her testimony is a clear indicator that inflation is actually getting out of hand. Inflation was so high that just a year ago, we had news such as this, where raising wages isn't enough to attract and keep workers. Higher wages lead to a higher cost and will reflect in prices. The Fed has been so reluctant to raise the rates because it knew that it wouldn't just crash the market, but also raise unemployment. We have already seen the news from giant tech companies that have been slashing their workforce. Coinbase will lay off 18% of its employees. Tesla already began laying off 10% of its workforce as well, with ex-employees confirming on LinkedIn that they have been laid off. Elon Musk even suggested possible layoffs at Twitter, even though the deal is not over yet. PayPal began firing employees since May. Tech companies have already realized that the age of cheap money is over, and it's time to cut the cost and prepare for the storm. A storm that is going to wipe the markets. High unemployment is a dangerous sign since it leads to lower aggregate demand. A recession often occurs when there is a widespread drop in spending and a general decline in economic activity. When it lasts longer than a few months or 2 consecutive quarters and is visible in real GDP, real income and employment, it turns into a recession. Soon, we'll find out how much unemployment has risen as a result of the Fed's actions. If a recession lasts for at least 2 years or the GDP shrinks by 10%, then it becomes a depression. If it wasn't for the Fed's loosening monetary policy, 2020 would have easily turned into a depression. The problem with easy monetary policy is that it solves the problem now at the expense of the future, which means sooner or later the taxpayers have to pay the price for avoiding a depression. That was Fed's plan from the beginning, but geopolitical challenges that the US is facing in 2022 are pushing the US to take drastic actions now before everything collapses. The consequences could be devastating if the US tries to solve the current problem by easing monetary policy. The World Bank even warned that we might face a 1970s stagflation crisis. Up until 1970s, traditional economics suggested that inflation falls when unemployment rises, since people have less to spend, which drives prices down. However, during the 1973 Arab-Israeli War, Arab countries imposed an oil embargo against the US in retaliation for the US decision to resupply the Israeli military. The shortage of oil in the market pushed oil prices to cross $100 per barrel, which caused widespread inflation since that increased the cost of transportation. The economy slowed and fell into a recession, but inflation kept rising. The Fed's credibility as an inflation fighter was lost. The end result was inflation was so high that it required 2 painful recessions to bring it down, as the Fed under Paul Volcker raised the federal funds rates to as much as 19%. And that's a scenario that could be at the end of the tunnel that is waiting for us, since inflation isn't just driven by cheap money, but also by high oil prices and shortages in the market. And that raises the question: how far should the Fed go to control inflation? 5%, 10%, or how about 19% as was the case in 1970s? If the Fed even raises the rates to 5%, that would already be a catastrophe. The second question is, how long will the Fed keep the rates high? 6 months, 12 months, 2 years? Remember that an increase in interest rates will lead to high unemployment, which will lead to a reduction in economic activity, which means a recession. And if it's long enough, then a depression. That's why experts are worried that a recession isn't really the worst case scenario, but a stagflation is. And now imagine for a moment, how will that impact the housing market? How strongly will high unemployment and high mortgage rates will hit the demand? And how much will the prices fall? Will they even fall when there is an overall inflation in the first place? Predicting the future isn't really just difficult, but as they say, there are as many predictions as the number of economists in the world. But what they all agree on is the fact that it will be painful. Any hike in interest rates will negatively impact the stock market, because a dollar tomorrow is worth less than a dollar today. At the end of the day, any company is valued based on how much money it earns, but a rise in interest rates lowers the value of future cash flow, which lowers the firm's value overall. Investors often use a method called discounted cash flow to find out the real value of a firm's future cash flow. If you want us to make a video about that in the future, let me know in the comments below. When we talk about investing, it shouldn't necessarily mean real estate, stock markets, or crypto. Let me tell you about an investment that is going to save you a lot of money. Internet is different everywhere. Games or streaming services have different price tags for different countries. Certain streaming services in the US cost $15.5, but in Turkey it costs less than $4. So what if you can get a subscription pretending to be in Turkey? That's where NordVPN comes into the picture, today's video sponsor. Imagine for a moment how much money you can save by using a VPN. With over 5,400 services in 60 countries, it is confirmed by speed tests that NordVPN is the fastest VPN out there. You can use it with up to 6 devices at a time. Browse the internet freely and protect yourself from hackers by using NordVPN. Threat protection is a major upgrade of NordVPN. It's the next step in protecting the users and offering a safer and smoother online experience. It blocks intrusive ads and web trackers while automatically scans URLs and blocks malicious ones. Not only that, it has the ability to block trackers, but also helps the users to avoid online spies and stalkers. Now, that's what we call a powerful security tool. Now, with NordVPN bundle deal, enjoy 3 plans for you to choose from: Standard, a VPN only, Plus, VPN Plus Pass, and Complete, VPN Plus Pass Plus Locker. All comes with bonus plus 1 month on top. It's super easy to use. Connect with 1 click or enable auto-connect for 0-click protection. Get exclusive NordVPN deal here at nordvpn.com/proactivethinker. It's risk-free with NordVPN's 30-day money-back guarantee.